Welcome to another episode of ETF 360. I'm Tom Lydon, along with our Director of Research, Dave Nadig. And joining us today is Sean O'Hara, who's president of Pacer ETF Distributors. Sean, thanks for being with us.
Thanks for having me, guys. Appreciate it.
Hey, Sean, one thing we're hearing from advisors is inflation is real. Rates can only go up from here. They're wondering if the 40 and the 60-40 is dead. Where can we go for real income and real returns today?
Well, I mean, the inflation question is a little bit open. Interest rates today are going the other way, back down on the Treasury. We just recently launched a couple of ETFs that employ a strategy that is designed to provide 3 and 4 times the dividend yield of the S&P 500 without using leverage. The two tickers are TRPL, triple, and QDPL, which is quadruple, which is 4 times the dividend yield on the S&P 500. And it's not a very complex process that we utilize to get there. Essentially, if I just focused on QDPL, which is the 4 times product, 88% of the portfolio would be invested in the S&P 500. The other 12% of the portfolio would be invested in T-bills that would be used as collateral to own futures contracts on the future dividends of the S&P 500. And so I can achieve a portfolio mix using that gives me a current yield in this environment of about 5.3%. And about 65% of that will be not taxable income to the end investor. So when you start to calculate what the net after tax is, it's a very attractive idea and opportunity in this environment where we're looking for yield anywhere we can get it, and the traditional sources aren't giving it to us. And perhaps one way, Tom, that people might use it, as you said, is that you were talking about 60-40 a little while ago. If we're going to sneak money out of the bond portfolio and into the equity portfolio because we're not getting any return, here's a way to do it with a little less equity exposure.
So Sean, one thing I think a lot of investors aren't familiar with is this futures market that you're participating in to generate that income. Can you talk to us a little bit about what it's like accessing that market? Is this sort of a small and a liquid market? Is this something institutions use but individuals may not know about? How do we put that in context?
Yeah, that's a great question, Dave. It's a huge market. The CME is the marketplace, and a lot of big institutional investors are using it to get access to dividend futures, for example. There are buyers and sellers on both sides of all of these markets. One of the sellers that people might not naturally think of would be the structured note players in this market. If you're familiar with the way structured notes work, they typically will, if it's going to have the S&P exposure, be the price only side of it. So they might be selling, for example, away their dividend exposure in this futures market. So it's a pretty large, pretty massive market in terms of the size of it and the number of players that participate.
Okay, so Sean, QDPL, just so we're on the same page here, 88% of the S&P performance you get on the upside and the downside, right? And the other, basically, let's say 12% of the assets are used to buy futures. And what's the current dividend yield on the S&P, for example?
Right now, it's about 1.33%. So, 4 times that dividend yield would give you, 5.2% plus effective yield. And as I said, the component parts of it are, you're getting part of the dividend from your 88% exposure to the S&P 500. So we actually own the S&P 500 with 88% of the portfolio. And then the remainder to fill in that 4 times the dividend comes from these dividend futures. And part of your annual payout will be based on the futures value. So you'll have a tax treatment on your normal dividend as qualified dividend for part of it. You'll have a tax treatment on that piece of it that's 60% long-term, 40% short-term. And part of it actually will be return of capital from a tax perspective. So about 65% of the 5.3% on the quadruple dividend product is not going to be currently taxable income. So very attractive in this environment.
All right. So old guys like me that are looking at retirement, and however, fortunately, we've got better medicine. We've got better technology today. Hopefully we're going to live longer, a longer time horizon in a potentially rising rate environment. You take some of that 60-40 on that 40 side and you push it over into something like this. Not as much volatility as the S&P 500, but based on current dividends, I'm getting more than 5%.
Yep.
And one
idea.
important thing here, you know what I'm going to say, Sean? No
Leverage.
no leverage.
That's an important
right.
part of it, right? And no counterparty risk either, right? You're talking about it, two liquid markets as far as your underlyings, and then you're talking about a liquid market that I get my dividend exposure from. The S&P 500 is as liquid as anything. Treasuries, obviously, T-bills is what we would use for the collateral, so we get a little tiny return there, but highly liquid. And then the dividend futures market is an enormous marketplace. So no leverage in this strategy, generating a very competitive and attractive current yield to the investor who's looking to have that part of their portfolio provide what it normally has been providing for the last 20 years, which is an attractive overall part to the total return. So
I'm going to be able to afford that bling, the chrome on my wheelchair?
Absolutely. You can even get an extra cushion.
Hey, Sean, thanks for joining us. Great seeing you.